The Untaxed Empire. How corporations escape nations and rules. There exists a shadow financial system operating parallel to every government, every law, every regulation you've ever known, while you declare every dollar to tax authorities, while you face audits and penalties for minor discrepancies. There are entities moving trillions through structures so sophisticated, so legally impenetrable, that entire nations become powerless spectators to their own economic sovereignty. Tonight, I'm going to show you how the wealthiest individuals and corporations on Earth have constructed an invisible empire that operates beyond the reach of any single country, any single law, any single authority. What I'm about to reveal isn't theory or speculation. These are documented systems, legal frameworks, and financial instruments that have been perfected over centuries by families whose names you know and dynasties whose power you've never truly comprehended. They've built a parallel universe where money flows like water through carefully engineered channels, where billions disappear and reappear across jurisdictions, where the concept of national taxation becomes nothing more than a suggestion for those who lack the knowledge to escape it. The numbers are staggering. Conservative estimates suggest that over $32 trillion in private wealth sits hidden in offshore financial centers. That's not counting corporate assets, sovereign wealth funds, or the increasingly sophisticated digital instruments that make traditional banking seem primitive by comparison. We're looking at an amount of money that exceeds the GDP of the United States and China combined, existing in a realm where traditional regulatory oversight simply cannot penetrate. But this isn't just about tax avoidance. What we're examining is the architecture of modern power itself, a system that allows certain entities to operate with the resources of nations while maintaining the legal protections of private citizens. They've created structures that can outlive governments, outlast political systems, and adapt to any regulatory environment faster than lawmakers can even understand what they're regulating. Consider this fundamental paradox. Every time you earn income, purchase goods, or invest money, you leave a digital footprint that tax authorities can trace, analyze, and tax accordingly. Yet there are individuals controlling assets worth hundreds of billions, who pay effective tax rates lower than middle-class professionals. This isn't happening by accident or through simple loopholes. This is the result of a deliberately constructed parallel financial ecosystem that operates on principles entirely different from the economic rules that govern ordinary citizens. The story begins not in modern tax havens or Silicon Valley boardrooms, but in the medieval banking houses of Europe, where certain families learned that true wealth wasn't just about accumulating money. It was about controlling the systems through which money moved. The Medici family didn't just make loans. They created the fundamental structures of international banking that still underpin global finance today. The Rothschild dynasty didn't simply accumulate gold. They built communication networks and financial instruments that allowed them to move wealth across borders faster than governments could track it. These early pioneers understood something that most people still don't grasp. Wealth at a certain level isn't just about having money. It's about having the infrastructure to make that money invisible to any authority that might wish to tax, regulate, or confiscate it. They built systems that could survive wars, revolutions, and the collapse of entire monetary systems. Today's offshore structures are the direct descendants of these medieval innovations, refined through centuries of legal evolution and technological advancement. The modern incarnation of this system began to take shape in the aftermath of World War II, when the Bretton Woods Agreement established the dollar as the world's reserve currency. But while governments were negotiating the official architecture of international finance, private interests were quietly constructing their own parallel system. Swiss banking secrecy laws, originally designed to protect Jewish assets from Nazi confiscation, became the template for a global network of jurisdictions that prioritized client confidentiality over government transparency. The genius of this system lies not in any single mechanism, but in its interconnected complexity. A billionaire doesn't simply open an offshore account and deposit money. Instead, they construct what financial lawyers call layered structures, interlocking networks of companies, trusts, foundations, and partnerships spread across multiple jurisdictions, each governed by different legal systems, each providing a different type of protection or benefit. Let me walk you through how this actually works. Imagine a wealthy individual wants to protect assets worth several $billion. They don't just hire an accountant, they engage what's known as a family office, essentially a private financial institution that exists solely to manage the affairs of a single ultra-wealthy family. These family offices employ teams of lawyers, accountants, investment specialists, and strategists whose sole job is to construct and maintain structures that make their clients' wealth as invisible and untouchable as possible. The first layer might be a foundation established in Liechtenstein, a tiny European principality with some of the world's strongest privacy laws. This foundation, legally considered a separate entity, becomes the nominal owner of various assets. But the foundation itself is controlled by a trust established in the Cook Islands, a jurisdiction in the Pacific where trust laws make it nearly impossible for creditors or tax authorities to pierce the corporate veil. The Cook Islands Trust, in turn, might be managed by a company incorporated in the British Virgin Islands, where corporate ownership information is completely confidential. But we're just getting started. The assets held by this structure aren't sitting in simple bank accounts. Instead, they're deployed through investment vehicles that add additional layers of complexity and protection. Private equity funds domiciled in Delaware, hedge funds operating out of the Cayman Islands, real estate holding companies incorporated in Luxembourg structure serves multiple purposes simultaneously, providing tax optimization, legal protection, and regulatory arbitrage. The beauty of this system, from the perspective of those who use it, is that no single government has the authority or ability to see the complete picture. Swiss authorities might see a bank account, but they don't know it's controlled by a Cook Islands trust. Cayman Islands regulators might oversee a hedge fund, but they don't know the beneficial owner is a Liechtenstein foundation. Each jurisdiction sees only one piece of a vast puzzle, and the legal frameworks governing international cooperation between tax authorities are so cumbersome and time-consuming that they're effectively useless for tracking modern wealth structures. This brings us to one of the most important revelations about how the ultra-wealthy operate. They don't just use offshore structures to avoid taxes. They use them to avoid the entire concept of national jurisdiction altogether. When you or I face a legal dispute, we're subject to the courts and laws of our home country. But sophisticated wealth structures can effectively choose their legal jurisdiction, moving disputes to forums where they have the greatest advantage, where judges understand the complexity of international finance, and where legal precedents favor privacy and asset protection over government authority. The Swiss banking system deserves special attention because it represents the pinnacle of this parallel financial universe. For over a century, Swiss banks have operated under legal frameworks that treat client privacy as more sacred than governmental transparency. Banking secrecy laws in Switzerland aren't just regulations, they're criminal statutes that make it a felony for bank employees to disclose client information without proper legal authorization. This created an environment where wealthy individuals from around the world could deposit assets with absolute confidence that their financial affairs would remain confidential. But Swiss banking secrecy goes far deeper than simple confidentiality. The Swiss developed sophisticated systems for managing wealth that allowed clients to control assets without appearing as the legal owners. Numbered accounts, where client identities were known only to a handful of senior bank officials, became the stuff of legend. But the real innovation was the development of trust structures and holding companies that could be controlled by clients through complex legal arrangements while maintaining complete deniability of ownership. The HSBC scandal that emerged in 2015 provided a rare glimpse into how these systems actually operate. Internal documents leaked from HSBC's Swiss private banking division revealed that the bank was actively helping clients evade taxes through sophisticated schemes that included creating shell companies, providing untraceable credit cards linked to offshore accounts, and even providing advice on how to structure withdrawals to avoid detection by tax authorities. The leaked files contained information on over 100,000 clients from more than 200 countries, holding a combined $100 billion in assets. What made the HSBC revelations so significant wasn't just the scale of the tax evasion, but the systematic nature of it. This wasn't a few rogue employees helping wealthy clients bend the rules. This was an institutional business model built around providing wealthy clients with the tools and expertise to make their assets invisible to their home country tax authorities. HSBC had teams of specialists whose job was to stay ahead of international tax enforcement efforts, constantly developing new structures and mechanisms to protect client assets from government oversight. The Panama Papers, revealed in 2016, took this investigation to an entirely different level. 11.5 million documents from the Panamanian law firm Mossack Fonseca revealed the inner workings of a global industry dedicated to creating offshore structures for the world's wealthy and powerful. But what shocked observers wasn't just the scale of the operation. It was the sophistication and creativity of the structures being created. Mossack Fonseca wasn't just creating simple offshore companies. They were designing intricate legal architectures that could serve multiple purposes simultaneously. A single structure might provide tax optimization for a Russian oligarch, asset protection for a Middle Eastern sovereign wealth fund, and political deniability for a European politician, all within a framework that was technically legal under the laws of various jurisdictions. The documents revealed that 12 current or former heads of state, including Vladimir Putin and the president of Ukraine, had connections to offshore structures. Over 140 politicians from more than 50 countries appeared in the files, along with celebrities, business leaders, and other public figures. But perhaps more significantly, the papers revealed the industrial scale of the offshore economy, with Mossack Fonseca alone having created over 240,000 shell companies and other offshore entities. If you found this information valuable, if it's changing the way you think about how the world really works, I need you to do something. Hit that like button and share this video with someone who still believes that everyone plays by the same rules. Someone who thinks that tax avoidance is limited to small-scale schemes and minor loopholes. The system I'm describing operates on a scale that most people can't even imagine, and the only way we can begin to understand its true scope is by sharing this knowledge with others who are ready to see behind the curtain. But the Panama Papers were just one law firm in one small country. The Paradise Papers, released in 2017, showed us that this system operates on a truly global scale. 13.5 million documents from 19 different offshore service providers revealed that virtually every major financial institution, law firm, and accounting firm in the world participates in creating and maintaining offshore structures for their wealthy clients. The Paradise Papers revealed something even more disturbing than widespread tax avoidance. They showed us that the offshore system has become so sophisticated and so integrated into the global financial system that it's effectively become the primary way that large-scale wealth is managed and transferred. Major corporations like Apple, Nike, and Facebook weren't using offshore structures as exotic tax avoidance schemes. They were using them as fundamental components of their business operations. Apple, for instance, had structured its international operations so that the intellectual property for its products was owned by subsidiaries in Ireland, which then licensed that intellectual property back to Apple's operating companies around the world. This meant that every iPhone sold in Europe generated royalty payments that flowed to Ireland, where they were subject to minimal taxation. But even Ireland was just one layer in a more complex structure that involved subsidiaries in the Netherlands and other jurisdictions, creating what tax experts call a double Irish-Dutch sandwich, a structure so complex that no single government could effectively tax the profits. What we're seeing is the evolution of a post-national economic system, where the largest corporations and wealthiest individuals operate according to their own rules, rather than the laws of any particular country. They've created structures that allow them to pick and choose which laws apply to them, which taxes they pay, and which regulations they follow. They exist in a space between nations, subject to laws they've had a hand in writing and regulations they've helped design. This brings us to the modern era of wealth concealment, where traditional offshore banking is being supplemented and in some cases replaced by technologies that make previous systems seem primitive. Cryptocurrency was supposed to be a transparent, decentralized alternative to traditional banking. But the ultra-wealthy and their advisors quickly recognized that properly structured cryptocurrency investments could provide even greater privacy and mobility than traditional offshore accounts. The key insight was that while blockchain transactions are theoretically transparent, the identities behind wallet addresses can be completely anonymous if proper precautions are taken. Moreover, cryptocurrencies exist outside the traditional banking system, meaning they're not subject to the same reporting requirements and international cooperation agreements that increasingly constrain traditional offshore banking. But the wealthy aren't just buying Bitcoin and hoping for anonymity. They're creating sophisticated structures that combine traditional offshore entities with cryptocurrency technology to create hybrid systems that offer the legal protections of established jurisdictions with the anonymity and mobility of digital assets. A trust established in the Cook Islands might hold its assets in privacy-focused cryptocurrencies like Monero or Zcash, stored in wallets controlled by smart contracts that can be executed automatically based on predetermined conditions. Even more sophisticated are the emerging tokenization structures, where real-world assets like real estate, art, or even entire businesses are converted into digital tokens that can be held and traded anonymously. A billion-dollar art collection might be tokenized and held through a network of anonymous wallets, with ownership transferable instantly across borders without any traditional financial institution ever being involved in the transaction. Artificial intelligence is adding another layer of sophistication to these systems. AI-driven trading algorithms can execute thousands of transactions across multiple exchanges and jurisdictions, creating transaction patterns so complex that they're effectively impossible for human investigators to follow. These systems can automatically rebalance portfolios across different assets and jurisdictions in response to changing regulatory environments, tax law modifications, or enforcement actions. Family offices are beginning to employ AI systems that can monitor global regulatory changes in real time and automatically adjust structure configurations to maintain optimal privacy and tax efficiency. These systems can identify emerging regulatory risks before they become enforcement actions and restructure assets across different jurisdictions faster than government authorities can coordinate their response. The historical precedents for this kind of financial sophistication go back much further than most people realize. The Rothschild family, for instance, built their fortune not just through banking but through creating information networks that allowed them to move money and information across borders faster than any government could track. During the Napoleonic Wars, the Rothschilds used carrier pigeons, coded messages, and networks of trusted agents to move assets across Europe, while governments were still communicating through official diplomatic channels. Nathan Rothschild's famous prophet from advanced knowledge of Wellington's victory at Waterloo wasn't just about having better information, it was about having the financial infrastructure to act on that information instantly across multiple markets and jurisdictions. The Rothschilds had created what we would now recognize as the first global financial network, with the ability to move assets, extend credit, and execute transactions across borders in ways that no government could monitor or control. The Rockefeller family took this model and applied it to the industrial age, creating structures that allowed them to control vast industrial empires while maintaining legal distance from the operational entities. The Standard Oil Trust, broken up by antitrust authorities in 1911, was actually an early version of modern offshore structures, a legal entity that controlled operating companies while providing the beneficial owners with protection from liability and regulatory oversight. But perhaps the most instructive historical example is the role of royal families and sovereign entities in developing wealth protection structures. European monarchies didn't just accumulate wealth, they created legal frameworks that allowed them to maintain control over assets across multiple generations and political systems. The Crown Estate in the United Kingdom, for instance, is structured as a corporation sole, a legal entity that can exist in perpetuity and is technically owned by the monarch in their official capacity, rather than as a private individual. This separation between personal and official capacity became the template for modern wealth structures that allow individuals to control assets without technically owning them. Today's ultra-wealthy use similar principles, creating structures where they can control billions in assets while maintaining legal distance that protects them from taxation, liability, and regulatory oversight. Sovereign wealth funds represent the governmental version of this same principle. Countries like Norway, Saudi Arabia, and Singapore have created investment vehicles that hold trillions in assets, while operating under legal frameworks that provide them with significant protection from foreign jurisdiction and regulatory oversight. The Norway Government Pension Fund Global, worth over $1.4 trillion, operates more like a private investment fund than a government entity, with the ability to make investment decisions without the political oversight that constrains other government activities. But some sovereign wealth funds operate with even greater secrecy than private offshore structures. The Saudi Public Investment Fund, for instance, manages over $600 billion in assets with minimal public disclosure about its investments, strategies, or performance. These funds operate in a gray area between public and private, governmental and commercial, domestic and international. That gives them extraordinary flexibility in how they deploy capital across global markets. The intersection of sovereign wealth funds with private wealth structures creates opportunities for collaboration that effectively puts certain assets beyond the reach of any regulatory authority. When a sovereign wealth fund partners with private family offices or investment vehicles, the resulting structures can claim sovereign immunity while operating with private sector flexibility, creating hybrid entities that are accountable to no one and subject to regulations. They essentially help, right? This brings us to one of the most important aspects of the modern offshore system: its role in perpetuating and concentrating power across generations. Traditional inheritance laws are designed to ensure that wealth transfers are taxed and that information about large purse estates is disclosed to relevant authorities. But sophisticated wealth structures can effectively eliminate both taxation and disclosure, allowing vast fortunes to pass from one generation to the next, while growing larger and more powerful over time. The key mechanism is the perpetual trust, a legal structure that can exist indefinitely without being subject to traditional inheritance taxes or disclosure requirements. Unlike simple trusts that distribute assets to beneficiaries after a set period, perpetual trusts can hold and manage assets across multiple generations while providing beneficiaries with access to income and benefits without ever actually transferring ownership. Dynasty trusts, established in jurisdictions like South Dakota, Delaware, and Nevada, can exist for hundreds or even thousands of years, accumulating assets and distributing benefits to successive generations of family members while never triggering inheritance taxes or estate disclosure requirements. These structures effectively create private family governments with their own rules, their own economic systems, and their own methods of decision-making that operate parallel to, but separate from democratic political systems. The implications are staggering. Families that establish dynasty trusts today can theoretically control those assets for centuries, growing their wealth through compound investment returns, while never paying estate taxes or inheritance taxes on the principal. A billion-dollar dynasty trust established today could theoretically grow to be worth hundreds of billions or even trillions of dollars over the next few centuries, all while remaining under the control of descendants who never technically own the assets but have unlimited access to their benefits. You're now privy to information that most people will never encounter in their lifetime. You're seeing behind the curtain of a system that operates in plain sight, yet remains invisible to the vast majority of humanity. If you're ready to go deeper, if you want to be part of a community that understands how the world really works, subscribe to this channel and hit the notification bell. Consider yourself initiated into a very exclusive club, those who understand that the game of wealth and power operates on levels that most people can't even imagine. The scale of assets managed through these structures is approaching levels that rival the economic output of entire nations. Private wealth management firms like UBS, Credit Suisse, and Goldman Sachs manage trillions in assets for ultra-high net worth clients, providing services that go far beyond simple investment management. These firms operate private banking divisions that function essentially as shadow financial institutions, providing lending, currency, exchange, investment services, and risk management for clients who require complete confidentiality and maximum flexibility. But even these major institutions are just the visible tip of an enormous iceberg. Single-family offices, which serve individual ultra-wealthy families, collectively manage assets worth trillions of dollars through structures so sophisticated that they make traditional banks seem primitive. These family offices employ teams of specialists in international tax law, estate planning, investment management, and risk assessment, whose sole job is to keep their clients' wealth invisible and protected from any form of government oversight or taxation. The largest family offices manage assets worth hundreds of billions of dollars for individual families, operating with budgets and resources that exceed those of many government agencies. They maintain offices in multiple countries, employ hundreds of professionals, and engage in investment activities that can move global markets. Yet because they serve private families rather than public clients, they operate with minimal regulatory oversight and virtually no public disclosure requirements. These family offices don't just manage money, they shape policy. They employ lobbyists, fund research institutions, and support political candidates who advocate for policies that benefit their interests. They've effectively created a parallel political system where their economic interests are protected and advanced through influence networks that operate largely outside public view. The regulatory environment that governs these structures is itself a product of their influence. International tax treaties, banking regulations, and cross-border enforcement mechanisms are negotiated by government officials who often move back and forth between public service and private sector positions serving the ultra-wealthy. The result is a regulatory framework that appears designed to enable the very activities it's supposedly intended to control. Consider the various international initiatives supposedly designed to increase transparency and cooperation between tax authorities. The Common Reporting Standard, implemented by over 100 countries, requires financial institutions to report information about foreign account holders to their home tax authorities. But the system is riddled with loopholes and exceptions that sophisticated wealth managers can easily exploit. Corporate structures trust arrangements, and foundation holdings are often exempt from reporting requirements. Digital assets, intellectual property, and alternative investments frequently fall outside the scope of international reporting agreements. Most importantly, the systems rely on cooperation between government agencies that often lack the resources, expertise, or political will to pursue sophisticated wealth structures across multiple jurisdictions. The enforcement mechanisms are even weaker than the disclosure requirements. International tax enforcement requires cooperation between multiple government agencies across different legal systems, languages, and political environments. The process is so slow and cumbersome that sophisticated wealth managers can restructure assets and move them to different jurisdictions faster than government authorities can coordinate their investigations. Even when enforcement actions are successful, the penalties are often less than the tax savings achieved through the offshore structures, making non-compliance a profitable business decision. Wealthy individuals and corporations can afford legal representation that costs millions of dollars and can drag out enforcement proceedings for years or even decades, often outlasting the political will or budgetary capacity of government agencies. The digital revolution has created entirely new categories of assets that exist outside traditional regulatory frameworks. Intellectual property, digital currencies, virtual assets, and algorithmic trading systems can be controlled through structures that have no physical presence in any jurisdiction, making them effectively immune to traditional enforcement mechanisms. Non-fungible tokens, decentralized autonomous organizations, and smart contract systems allow wealthy individuals to control assets through mechanisms that exist purely in digital form, with ownership and control distributed across networks that span multiple jurisdictions and legal systems. These structures can execute transactions, manage investments, and distribute income automatically based on predetermined algorithms, with no human intervention and no single point of regulatory control. The intersection of artificial intelligence with offshore wealth management is creating systems of unprecedented sophistication and opacity. AI-driven investment algorithms can manage portfolios across thousands of different assets and jurisdictions simultaneously, making investment decisions based on analysis of global market conditions, regulatory changes, and enforcement patterns that no human manager could possibly track. These systems can automatically restructure holdings in response to changing conditions, moving assets between jurisdictions, converting between different asset classes, and adjusting ownership structures in real time to maintain optimal tax efficiency and regulatory protection. They operate at speeds and with complexity levels that make traditional regulatory oversight impossible. Machine learning systems are being trained on decades of regulatory data to identify patterns and predict future enforcement actions, allowing wealth managers to stay ahead of regulatory changes and restructure assets before new rules take effect. These systems can analyze the voting patterns of legislators, the career backgrounds of regulatory officials, and the enforcement priorities of different agencies to predict policy changes years in advance. But perhaps the most significant development is the emergence of autonomous wealth management systems that can operate indefinitely without human intervention. These systems combine artificial intelligence, blockchain technology, and legal structures to create what are essentially robotic family offices that can manage and protect wealth across multiple generations without requiring ongoing human management. Smart contracts can be programmed to distribute income to beneficiaries, reinvest profits, and restructure holdings based on predetermined conditions. With the entire system operating through decentralized networks that exist across multiple jurisdictions simultaneously, these structures could theoretically operate for centuries, accumulating and protecting wealth while remaining completely autonomous and immune to regulatory interference. The philosophical implications of these developments are profound. We're witnessing the emergence of a post-human economic system where vast amounts of wealth are controlled by algorithms and managed through structures that operate independently of human oversight or democratic accountability. These systems accumulate power and resources, while remaining completely detached from the social and political systems that govern ordinary citizens. Traditional concepts of taxation, regulation, and democratic oversight become meaningless when applied to structures that exist primarily in digital form, operate across multiple jurisdictions simultaneously, and can restructure themselves automatically in response to changing conditions. We're approaching a point where the wealthiest entities on Earth will be completely autonomous systems that accumulate resources while remaining accountable to no human authority. The concentration of wealth and power in these structures is accelerating at an unprecedented rate, as artificial intelligence and automation eliminate many traditional employment opportunities. The returns to capital ownership are increasing, while the returns to human labor are declining. But access to sophisticated wealth management structures is limited to those who already possess substantial assets, creating a self-reinforcing cycle of wealth concentration. The ultra-wealthy are using these structures not just to preserve their existing wealth, but to position themselves to benefit from the economic disruption caused by technological change. They're investing in the technologies that will replace human workers while using offshore structures to ensure that the profits from these investments flow to them rather than to the broader society. As artificial intelligence and automation reshape the global economy, those who control the capital and technology will capture an increasing share of the economic benefits, while those who depend on human labor will find their economic position increasingly precarious. The offshore wealth management system ensures that these benefits will be concentrated among a small group of ultra-wealthy individuals and families, while remaining largely invisible to government authorities and democratic oversight. The scale of this transformation is difficult to comprehend. We're witnessing the emergence of a global economic system where the most important decisions are made by algorithms controlled by individuals and entities that operate outside any democratic or regulatory framework. The traditional social contract between wealth and citizenship. The idea that those who benefit from society's resources should contribute back through taxation and political participation is breaking down completely. Before we conclude this investigation, I need you to do something that will help expose this system to others who need to understand what's really happening. Go to the comments section and type the single word "invisible," and then share this video with someone who still believes that our economic system is fundamentally fair and transparent. Someone who thinks that everyone is subject to the same rules and regulations. The system I've described operates at a scale and with a sophistication that most people can't even imagine. And the only way we can begin to address it is by making it visible to those who are ready to see the truth. The ultimate question we must confront is what this system reveals about the nature of power and democracy in the modern world. We've created a global economic system where the wealthiest individuals and entities operate according to their own rules, while ordinary citizens remain subject to increasingly restrictive regulations and oversight. The concept of national sovereignty becomes meaningless when private entities control resources that exceed the budgets of most governments and operate through structures that no single government can effectively regulate. The offshore wealth management system isn't just about tax avoidance, it's about the creation of a parallel economic and political system that operates according to principles fundamentally different from democratic governance. It's a system where power derives from wealth rather than popular consent, where decisions are made by algorithms rather than elected officials, and where accountability flows to private interests rather than public welfare. The implications extend far beyond taxation and regulation. When the wealthiest entities in society operate outside democratic oversight and accountability, they accumulate not just economic resources, but political and social power that they can deploy to shape society according to their interests rather than the broader public good. They can influence policy, shape public opinion, and direct social development, while remaining largely invisible to the democratic processes that supposedly govern our societies. The offshore system represents the culmination of a process of wealth concentration and power accumulation that has reached a point where it threatens the fundamental principles of democratic governance and social cohesion. We're approaching a world where the most important decisions about technology, economics, and social organization are made by entities that operate completely outside democratic accountability and oversight. The traditional mechanisms of democratic control, taxation, regulation, transparency requirements, and electoral accountability have proven inadequate to address the sophistication and scale of modern wealth concentration. The pace of technological change and the complexity of global financial structures have outpaced the ability of democratic institutions